The only thing I would say
long term
is that people will have to understand. I mean, put this into context, they have to understand it's not gold going up, but it's the currencies going down. In this case, the dollar. It's the currency falling in terms of its purchasing power. That is the People's Bank of China are buying gold. It's not so much they're buying gold, they're selling dollars.
Right.
Do they want to buy another currency? No, they don't. They don't want to buy they don't want to buy euros because it's exactly the same story, or sterling or whatever, or even Japanese yen. They don't want to buy those. Where else do you go? You get out of fiat and you get into real money, which is gold. And that's what they're doing. And this is why there's so much speculation, if you like, about China's long-term intentions in terms of guaranteeing the value of the yuan. Will they go onto a gold standard? I mean, there's no doubt about it that China has been accumulating gold ever since the People's Bank of China was appointed by law back in 1983 to handle the Communist Party's acquisition of gold and silver. That was 1983. They accumulated as much as they wanted up until 2002, when obviously they decided that the state had had enough, and incidentally, they became the largest nation by gold mine output. And that was a deliberate act of policy. They also imported doré, and they're still been importing gold from outside China, in particular from our markets. In 2002, they decided that they'd got enough gold, and it was now the time for private individuals to acquire gold. Why? Well, I mean, if you go back to Marxist theory, and this is what they were teaching in all the universities in China. I mean, really from the time of Mao Zedong all the way up until fairly recently. They're probably still teaching it as far as we may know. But they've been saying that capitalism will eventually fail, and that's once it's failed. That the next step is to go into the sort of the communist. The interesting thing is that Marx was talking about the bourgeoisie, and of course, we hear about this and we sort of immediately associate Marx with the destruction of the bourgeoisie. That actually wasn't quite his policy. His policy basically was that the bourgeoisie basically make the money and get the economy to the sort of state their wealth can be transferred to the state on behalf of everybody else.
Yeah.
So as far as Marx was concerned, the bourgeoisie were doing the communist god's work.
And the Soviet Union is where they went wrong, according to the Marxists, is that they put the cart before the horse. They didn't allow the capitalists to build out the base for the communists to then take.
Get back to, I mean, as far as they're concerned, if they can see that capitalism in the West is going to fail, then obviously their fiat currencies would go with it. That's why they had a gold policy. And incidentally, it's also why they had a silver policy, which, of course, I think very, very few people really realize. I mean, it's interesting. I attended a conference in New York, which I was speaking at. That must have been about 2011, I think probably about 2013. So we're talking, a bit over 10 years ago. And there were lots and lots of silver exploration companies exhibiting at this conference. And at the time, there was a lot of, sort of conspiracy theory stuff about how JP Morgan were banging the market every 5 minutes. And then you had, what was her name? Blythe Masters, who was head of the commodity side. She deliberately went on I think it was CNN, make it absolutely clear that JP Morgan did not take positions in the silver market. Now, of course, everybody running the conspiracy theory sort of thought, well, yeah, this woman's lying. But I can tell you, I've known people like Blythe Masters, and they are extremely careful about what they say in public. They really are. There's no way she was lying. Going back to the conference, I asked these silver miners, I said, right, when you produce your silver output, doré, whatever, how do you turn it into cash to pay the wages and pay all the energy bills and all the rest of it? And they all said exactly the same thing. A man from Glencore comes around, he assesses the value of the doré, then they're paid by a bank, which presumably was JP Morgan, because if you're talking about a large lot like Glencore, it's obviously JP Morgan. It's then shipped off, and I said, well, where's it shipped off to? They said, well, we don't know, but I mean, presumably China, but we don't actually know for certain because it's not our business anymore. I mean, we're just paid when it leaves the site. If you look at the other end of it, obviously JP Morgan would also be acting for China on the futures market. So what we have, and it's quite easy to understand, what we have is we have silver in the form of Dory, but it's still silver, bypassing the market and then being hedged in the market. So that was the suppression. They were doing this. They've been doing this for ages. And bear in mind that China is something like the fifth largest producer of silver in the world itself. I mean, she produces a lot of silver and she was importing this stuff. I mean, at the time, it sort of played into her hands because refining silver isn't a very environmentally friendly process. I think the Canadians pretty much stopped it. So, I mean, the Chinese were quite happy to do it. And so they accumulated a hell of a lot of silver. And if you look at the Silver Institute's numbers and how there's always a shortfall, certainly in recent years, of supply on demand. I mean, where's the difference come from? I guess China's basically been feeding the market to try and control the price.
It's crucial to begin with a simple but oft-forgotten truth. Gold isn't going up because of strength. It's the erosion of currencies that's driving its ascent. Specifically, it's not gold we're buying, it's dollars we're abandoning. Gold serves as a durable anchor when money itself becomes suspect. The People's Bank of China isn't buying gold because they covet bullion. They're purchasing it to offload dollars, not euros, yen, or sterling, which carry the same fiat pathology. They want real money. To understand why this matters, we need to trace history and mindset. China has maintained a gold accumulation policy for 4 decades. Back in 1983, the PBOC was officially tasked with managing China's gold and silver assets. From that point until around 2002, they acquired gold extensively, teaching a generation that holding gold was national policy. After 2002, with China becoming the largest gold mine producer on Earth, the shift moved toward encouraging private accumulation too. This wasn't accidental, it was Marxist-ish market economics, a strategic layering of capital stability into the fabric of the nation. After all, if fiat fails, you need something reliable. So you build a gold foundation. Contrast that with the West. While China has been quietly fortifying its gold bulwark, our mainstream media treats gold as a luxury, a relic, or worse, a hedge for conspiracy theorists. They still talk about gold rallies needing dovish central banks, when in fact, gold rallies with confidence dumps, with rate hikes, with debt stress. Gold rises when real yield erodes because debt becomes more frightening than inflation. What does all this mean for everyday citizens and investors? It means you don't buy gold to get rich. You buy gold to pay less to stay solvent. And that's a nuance most financial advisors miss. Gold isn't growth, gold is backup. Now let's talk silver. If gold is the financial anchor, silver is the industrial battery pack. Silver is essential in solar panels, EVs, electronics, and yes, weaponry. But here's the kicker. Supply isn't responsive. Only about 18% of annual silver comes from dedicated silver mines. The rest is a byproduct or recycled metal. That means when demand increases, supply barely budges. You may remember the wild conspiracy talk around silver manipulation, especially involving JP Morgan and the London Bullion Market Association. In 2013, on a panel in New York, I asked silver miners, "You produce d'or. Where does that go?" They all said variations of, "It's sold to a trader. We don't know exactly where it ends up. It leaves sight. We get paid." Presumably, that trader is often JP Morgan. The metal is refined in China, then vaulted in Shanghai, Hong Kong, Singapore. That's strategic accumulation through obfuscation. All the while, Western banks hold massive short positions on COMEX, pushing prices down to build positions for the war machine. 8 Western banks with the largest concentrated paper short position in any commodity ever. That's not an accident. That's state-level supply management. It also explains why we see London delaying gold and silver deliveries, longer settlement windows, longer logistics. It's not trucks, it's liquidity. Suppression can be orchestrated for a time, but it only accelerates demand. And when the backlog overwhelms it, the dam breaks. But let's not stop there. We also have geopolitical signs. Judy Shelton, among others, has been floating the idea of gold-backed treasury instruments timed for independence anniversaries, or perhaps for economic resets. Trump's tweet, "He who has the gold makes the rules," isn't soundbite theater. It's elite signaling, akin to Federal Reserve speech phase shifts, only measured and targeted. Gold reserves don't move overnight. They move through orchestrated accumulation. That's what China has done for decades. That's what BRICS is engineering through physical spot conduits and alternative settlement systems. That's what happens when fiat starts failing its own tests. Trust declines and people begin building asset protection layers. So what does the investor do with this awareness? Let me offer a basics to strategy ladder. Bullion first. Own physical gold and silver in segregated form that you control. Don't rely on digital claims or unallocated storage. Next, high-quality producers. Gold miners with disciplined management, strong margins, cash flow, and balance sheets. Then developers and late-stage juniors. Projects with resources and jurisdictional stability, but still undervalued compared to what should happen post-repricing. Finally, speculation stage. Explorers and single asset plays that can return multiple times your stake, but are highest risk and most volatile.
And also, of course, they're the largest global manufacturers of photovoltaic cells. I mean, they've got every reason to have a huge stock of silver. Mm-hmm. The other thing I discovered, which was fascinating, was that China's exports in 2023 of silver, I think the figure was something like 250 million ounces. It matched pretty well exactly the Silver Institute's shortfall on its assessment. Now, the other thing that was interesting is if you look where the silver was sent, it was sent to London, it was sent to Hong Kong. I think Singapore was in there as well. Most of it going to those centers. Now, these are not large consumers of silver, but they are financial markets. That tells me that they were suppressing the price. We now have a situation where I just wonder whether it's in their interests anymore to continue to do that. And so far as I can see, the 2024 exports of silver have been significant, but not to financial centers. So I think there's a sort of change in China's thinking. Very, very interesting. China has accumulated huge quantities of gold. Now, if you look at Russia, apart from what the central bank's got, which I think is 2,000 tons or something, I'm told by fairly well-informed sources that there are two wealth funds. One is called the Grok Fund, believe it or not. Those funds have got something like 10,000 tons of gold between them. That's what we're told. So they've got around about 12,000 tons of gold. Not only that, but they're accelerating their mine output. They're now, I think, joint second largest producer with Australia, something like that. The central bank holding is about 2,000 tons. There's another 10,000 held in various principally two wealth funds. Okay. But when it comes to mine output, I think we're looking at about 350 tons. I mean, this is off the top of my head.
Of silver. I was thinking about gold.
But Russia could go onto a gold standard tomorrow. I mean, it's fascinating how the propaganda, the anti-Russia propaganda, because of the war and because of Putin and all the rest, is such that you get serious writers, economic commentators saying that Russia's bust. It's not. I mean, its GDP is less than 20%. The tax rate for ordinary people, income tax is around about 13%. I mean, if you make a lot of money, you pay 15%. Corporation tax is about 25%, which is the same as it is in the UK, similar, I think, in America and Canada. The inflation rate is high. Yeah, I mean, it's running at something like 8%. Now, I don't know whether that's because they actually report a proper inflation rate, which we don't. I mean, John Williams would argue that we've had 8% inflation and more for some considerable time in the United States. In Russia, people's wages have been rising very, very sharply. I mean, if you're employed, I think there's a reasonable level of employment, then you're getting wage rises of, sort of 20, 30%. I mean, this is against an inflation background of, around about 8%. And so what banks are doing is banks are encouraging people to save. And these guys are saving, which we don't do. They have an economy which actually could switch, very, very quickly into a gold standard.
Let's now turn our attention to silver, because while gold is undoubtedly the anchor of sound money, silver is its more volatile industrial sibling, and perhaps its most strategically manipulated. It is, to borrow a phrase, the asymmetrical trade of the century. Silver remains dramatically undervalued relative to its monetary and industrial roles. It has utility in solar, semiconductors, batteries, electric vehicles, water purification, and, notably, aerospace and defense systems. But unlike copper or nickel, which have widely reported and understood flows, silver has a unique problem: intentional opaqueness. No one really knows exactly how much silver China holds, or how much is off balance sheet in military stockpiles across the West. And that, I would argue, is by design. Let's build on the thread we opened earlier. The military-industrial complex has likely been suppressing the paper price of silver for years, possibly decades. Why? Because they need it. Not want, need. Cruise missiles, drones, space-based defense systems, they all rely on high-purity silver. As mentioned, between 13 and 15 kilograms of silver per Tomahawk missile, that's 500,000 ounces for every 1,000 deployed. In modern warfare, silver isn't optional. It's strategic. Now let me take you behind the curtain. If you look at the London Bullion Market Association, LBMA, and you follow the work of analysts like David Jensen, what you find is staggering. The LBMA claims about 800 million ounces of silver in vaults, of which over 500 million ounces are encumbered by ETFs like SLV. That leaves roughly 290 million ounces of float. Now here's the real kicker. LBMA banks admit, via surveys, that they are trading up to 10 times that posted number daily. That's 2.9 to 3 billion ounces of silver changing hands every single day. That's over 3 times annual global mine supply, most of it in naked paper form. And yet somehow, the spot price doesn't move. That is manipulation, not market action. Meanwhile, in the US, we're seeing record delivery requests on the COMEX, 16,000 contracts in May alone, over $5.3 billion in gold delivered in a quiet month. And silver is no different. A stunning 13,581 contracts were delivered in May, an all-time record. And curiously, much of this metal is moving from banks to non-banks, a trend we don't see in gold. That raises big questions. Who are these non-bank entities? Industrial buyers? Sovereign frontrunners? Either way, it smells like structural change. Let's zoom out even further. China, Russia, India, they aren't just buying silver and gold. They're disintermediating the pricing mechanism. China is reportedly paying above market price for silver concentrate on door in South America, particularly Peru, and shipping it back for refining. That tells us 2 things. 1, they're sidestepping Western markets, and 2, they're absorbing supply at the source, making it harder for the West to even see what's happening. This has massive implications for the global economy. As Zoltan Passer said, we're transitioning into Bretton Woods 3, a commodity-based reserve system. The old world was built on trust in treasuries. The new world is being built on trust in tangibles. And in that world, silver's suppressed price becomes a vulnerability, not an asset, for the incumbents. Let's not forget, you can only suppress a commodity for so long by pushing it in the direction it's already going. Once the trend reverses, and once nations like China and India start standing for delivery en masse, the rubber meets the road. That's when paper contracts collapse and physical supply becomes paramount. And we're not alone in recognizing this. Central banks are now net buyers of gold for 14 consecutive years. In 2023 alone, over 1,037 tons of gold were acquired, most of it by non-Western banks. That figure doesn't include unreported purchases by entities like the People's Liberation Army or Iran's central bank. These actors don't file 13 Fs. They move silently and they move big. If we consider what this means for gold's long-term valuation, the implications are extraordinary. Gold at $3,300 isn't a top. It's a midpoint. At $3,300, using historical silver ratios of 45-1, silver should be at $73. But if we go back to geological ratios, 7-1, silver should be at $10.1, then silver ought to be priced at over $470. Will it go there? Maybe not tomorrow, but markets have a way of overshooting, just like they undershoot. Don't dismiss it. Remember, in 1989, the idea of the Dow at 40,000 was laughable. Here we are. We're also watching a tectonic shift in monetary policy narratives. In Washington, you have people like Judy Shelton proposing a new Bretton Woods, where treasuries may be gold-backed once again. Her suggestion that July 4th, 2026, the nation's 250th birthday, could serve as a monetary reset isn't just nationalism, it's timed messaging. If that happens, or even if a gold-backed security is floated as a trial balloon, it could utterly shatter the perception of fiat permanence. And let's be clear, the US government might be the biggest buyer in the market today. There's increasing speculation that May's record deliveries weren't from hedge funds or institutions, but from Treasury itself. If that's true, and voices like Vince Lancy and Luke Gromen believe it is, then the picture changes. The government isn't just accumulating gold, it's reclaiming sovereignty, and it's doing it at suppressed prices while talking up strong dollar policies. You see the pattern? Every time the price spikes, the media screams gold bubble or blames geopolitical tensions. Then it crashes, and within 72 hours, China or BRICS or US Treasury buys the dip. Rinse, repeat. They want the metal, not the momentum. This brings us to a final and sobering truth. In a world of shrinking trust, the institutions that survive will be those backed by tangible collateral. That means commodities, gold, silver, energy, uranium, lithium, not debt. And the average saver who clings to fiat, who looks for yield in collapsing bond markets, is being slowly boiled like a frog. So let me leave you with this. When the rules change, only the prepared prosper. You don't need to know the date of the reset. You need to know it's coming. You don't need to know whether silver hits $470, but you must know that $27 is an illusion. Be early, be quiet, be right.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.